In 2020, the world was hit by an unprecedented shock, COVID-19. As the world came to a halt, oil prices collapsed. But what did we learn from another oil price shock with far-reaching consequences back in 2014? I'm Iulia Teodoru from the IMF's Middle East and Central Asia Department, and I specialize in the economies of the Caucasus and Central Asia, or the CCA region. Specifically Armenia, Azerbaijan, Georgia, Kazakhstan, Kyrgyz Republic, Tajikistan, Turkmenistan, and Uzbekistan, home to around 80 million people. Many economies in the region are highly dependent on oil. So in 2014, when oil prices plummeted, the shock waves were widespread. Bank liquidity became tight, loans were not repaid, banks became undercapitalized, and large government bailouts took place, as we see in the chart, ranging from 6 to 22% of GDP. Confidence in banks was undermined, and financial deepening and inclusion has remained low. As we see in the chart, banking assets in most CCA countries are lower than in emerging markets. Could the 2014 experience provide a guide on how to respond to the COVID-19 and oil price shocks? How to prevent another episode of costly bank distress, secure credit in support of the post-COVID economic recovery, and enhance financial inclusion in the long term? Put another way, addressing potential credit, foreign currency and liquidity issues early would better prepare the region to face the ill winds that are coming. First of all, the COVID-19 crisis is adding to existing risks to financial stability. Its impact is still unfolding, underscoring the need to act preemptively. Large credit cycles in some CCA countries magnified systemic risk in the past. Shocks to growth and exchange rates from the pandemic have been sharper than in previous crises. The chart illustrates these effects. Rising delinquencies will likely affect banks' soundness and their ability to lend. It may also lead to costly public interventions, as in the past. Our stress tests identified key risks and pockets of vulnerability in order of importance. Liquidity risk. Under very severe liquidity shocks, including on their foreign currency liabilities, about half of the banks in the region could become illiquid. Foreign currency credit risk in dollarized CCA economies, where unhedged borrowers default, could lead to a reduction in bank capital ratios by about 6 percentage points, from 25 to 19%. More broadly, an adverse scenario, higher levels of non-performing loans could reduce such ratios by 5 percentage points across the region, from 25 to 20%. Here, the blue line shows rising NPLs and the red line the impact on capital ratios. In addition, these shocks could happen simultaneously and have compounded effects. So what can be done now to limit these risks and durably secure financial resilience and sustainable credit and economic growth while avoiding large fiscal costs and follow the lessons learned from the past? The short term. Supervisors should focus on liquidity and asset quality and perform forward-looking analysis of key drivers of balance sheet impairment. It will be important to rebuild buffers fast if financial sectors are to support the recovery. Past experience, including in the CCA, shows how to achieve this, including by raising additional capital from existing or new private shareholders, or by retaining more profits by limiting dividend payments. Promptly recognizing losses will avoid maintaining insolvent borrowers afloat and eventually draining public resources. This process will be aided if borrowers can manage their debts through strong private sector insolvency regimes. The medium term. Key reform priorities for the CCA region should focus on strengthening financial sector policies to promote stronger risk management practices by banks. In particular, Macroprudential policy should be used more to shield against systemic shocks, for example, by building countercyclical capital buffers or mitigating foreign currency risks. Finally, efficient bank resolution frameworks are also critical to maintain sound banking systems and financial stability. The longer term. Financial sector vulnerabilities in the region have deep-rooted structural causes. Transitions to private sector-led economies are unfinished. Economies are highly dependent on oil and remittances. Banking systems remain small and dollarized, and further structural reforms are critical to enhance financial inclusion. First, reducing the state footprint, including through bank ownership or subsidized lending, and increasing competition and financial transparency are priorities to establish a risk culture and market discipline. Second, strong institutions are critical for sustainable financial development. In addition to risk-based supervision, these include strong legal frameworks to enforce contracts, collateral, and expedite debt restructuring, as well as key financial infrastructure such as credit information availability. Finally, efforts to develop capital markets and fintech will also bring benefits in making financing sources more broadly available and more diverse. In conclusion, our analyses highlight that addressing financial sector weakness in the CCA region should build on a holistic approach, combining the full range of short to long-term financial sector policies and reforms, as well as benefiting from experience both in the region and around the world. Doing this will be critical to secure economic stability and growth.